Stock Market Documentary Channel presents Monetary Collapse and Financial Crisis. Hillary Clinton may turn into the principal female president of the United States, yet she'll never be as effective as Janet Yellen. The leader of the Federal Reserve reported that loan costs would stay put, taking note of that financial movement has moderated and, accordingly, buyer spending has declined. Regardless of the hopeless point of view toward the U.S. economy and appalling first quarter total national output, GDP, development of 0.5%, the overbloated S&P 500 sticks to falsely low loan fees to spare itself from itself. Psychic Federal Reserve eerily well informed? The Federal Reserve didn't generally astound anybody, or if nothing else I trust nobody was taken by surprise, when it declared it was holding its key loaning rate in the scope of 0.25% to 0.50%. Back in December, the Federal Reserve declared its top-notch increment in right around 10 years, saying future rate climbs in 2016 would be continuous. Most assumed this would mean 4 moderate rate tracks. In any case, that assumption is in peril now, as the U.S. economy stays delicate. Expects that frail worldwide development and an excited securities exchange could advance harm the U.S. economy implies we are not out of the forested areas only yet a long way from it. For financial specialists, that implies more shoddy cash. As anyone might expect, markets reacted in kind, moving higher after the declaration. Still, most think the Fed will bring rates up in June. In any case, in all honesty, if the measurements-hungry Fed pays consideration on its own information, I think a June rate climb is off the table. Yes, Yellen noticed that the worldwide monetary markets are enhancing and made light of late shortcoming in the U.S. economy, yet I surmise that tentative positive thinking might be somewhat untimely. Weakest GDP growth in 2 years. In the Federal Open Market Committee, FOMC, explanation, Yellen watched that U.S. monetary movement had impeded and decreased levels of customer spending. That is bad news for an economy that gets by far most of its GDP from shopper spending. Still, the shockingly clueless experts on Wall Street keep on waxing expressiveness about the qualities of the U.S. economy. One marvels why when U.S. gross domestic product has been declining for the last 4 quarters and most as of late, we discovered that the U.S. economy reeled ahead at a 0.5% pace in the primary quarter as shoppers put the brakes on spending and organizations cut back on ventures. Anticipating that first quarter GDP should propel a regal 0.7%, examiners appear to be astonished that the economy stays powerless. All things considered, the worldwide economy doesn't appear to be all that terrible, managers are procuring, and the share trading system has recuperated from the mid-February lows. That is every one of the somewhat rich. China's first quarter GDP development diminished to its slowest pace following the principal quarter of 2009, growing 6.7%. China's economy extended at an occasionally balanced rate of 1.1% in the principal quarter from the final quarter of 2015. That is the most minimal quarterly development since 2010. China, the world's second greatest economy, reported 2015 GDP development of 6.9%, its weakest development rate in a quarter century. With respect to U.S. occupations, business rebounded in March, including 215,000 employments. A large portion of the livelihood increases, 48,000, originated from low-paying retail and sustenance administrations, 25,000, while work misfortunes originated from the higher-paying assembling, 29,000, and mining, 12,000, zones. The official unemployment rate is 5%, however the underemployment rate has just fallen by around 1% since last March and stands at 9.9%. Stocks rise along despite declining earnings. The share trading system has made a striking recuperation from its February lows. Be that as it may, those additions aren't an after-effect of dazzling first quarter income and income development. The business sectors are bouncing back on the grounds that speculators are overlooking the profit retreat we are in and, being restless, are hanging their contributing top on misleadingly low financing costs and the well-meaning idea that the US economy is going to bounce back soon. They must hold up a while longer. The US is in an income subsidence. It's hard to perceive how powerless income point to higher stock valuations and are an impression of an enhancing US economy. I enter as confirmation, on December 31, 2015, the assessed income development rate for the main quarter of 2016, which was 0.3%. Quick forward to March 18 and the evaluated income decrease was 8.4%. Toward the end of the quarter, the assessed profit decay for the primary quarter expanded to 8.7%. Welcome first quarter income season. By April 15, the main quarter mixed income decay was 9.3%. By April 22, with 26% of organizations in the S&P 500 reporting first quarter profit, the mixed income decay enhanced to simply 8.9%. Remember that 74% of S&P 500 organizations need to report first quarter profit. That number will perpetually change. Any changes to mixed income will be negligible, best case scenario. On the off chance that the S&P 500 reports a decrease in income for the principal quarter, it will check the first run through the file has seen 4 back-to-back quarters of year-over-year decreases in profit following the final quarter of 2008 through the second from last quarter of 2009. During an era when corporate America is cautioning that income will be down altogether, stock valuations have been rising. Since the business sectors bottomed amidst February, the S&P 500 has taken off more than 13%. It doesn't make any sense. Be that as it may, once more, you can't battle the Fed. In the end, financial specialists will need to grapple with feeble essentials and how they are reasonably supporting a matured positively trending market. Thank you for watching. Please subscribe to our channel. Stock Market Documentary Channel presented.